Hello, everyone. It's Tuesday, February 24th, 2026, and Bitcoin just dipped below $63,000. Liquidations are flying. The Fear and Greed Index is sitting at 11. And somehow, people are still surprised. Welcome back to the most rational show in an irrational market. I'm SENB and this is the SENB Daily Brief. If you're feeling nervous today, congratulations. You're officially experiencing what we call price discovery with emotional consequences. So, let's talk about what's actually happening today. Stay with me.
You're listening to the SENB Daily Brief, powered by Whole Shot Coffee.
All right, let's get into the numbers. Bitcoin on the 2-hour chart wicked down below 63,000, tagging lows around 62.7 to 62.9 before catching a small bounce. Right now, it's trying to stabilize in the 63 to 64 range, but the tone is still heavy. In the last 24 hours, we're looking at roughly 4 to 5% down on Bitcoin. Ethereum is sitting around 1857, Solana around 78, XRP around 135. Now zoom out. Here's what matters. Total crypto market cap is hovering around 2.2 trillion. 24-hour volume still high, around 100 billion plus. Fear and greed is at 11. Extreme fear. And Bitcoin dominance is around 57.9%. Translation: money is rotating toward Bitcoin while the rest of the market bleeds harder. And even Bitcoin isn't exactly acting like a safe haven today, which is kind of the whole vibe. Okay, we're going to a quick break, but when we come back, we're going to talk about what is driving this BTC dip. Stay with us.
You're listening to the SENB Daily Brief, powered by Whole Shot Coffee.
All right, welcome back. So, Bitcoin just took another leg down, and this one wasn't random. In the last 24 to 36 hours, February 23rd into early U.S. trading on the 24th, BTC broke below $63,000, tagging lows between roughly 62.7 and 62.9. That extends the multi-week correction. Now let's break this down properly. Who's involved? Retail traders getting margin called, institutional desks rotating out of higher beta risk assets, ETF investors pulling capital, and analysts from Bloomberg, CoinDesk, and CryptoQuant calling it what it is, a macro-driven unwind. And on the policy side, the tariff escalation is coming straight out of Washington from the White House and Trump's trade team. What happened? Bitcoin broke below 63,000 during early U.S. hours. The move wasn't isolated to one exchange. Volume was heaviest on Binance and Coinbase, meaning this was global participation. And it wasn't just crypto. Macro pressure spilled into Wall Street. Microsoft weakness, AMD weakness, broader tech softness. That's your first clue. This isn't a crypto narrative problem. Why did this happen? Two pressure points collided. First, Trump's 15% global tariff hike moving forward despite Supreme Court pushback. That raises inflation concerns, liquidity concerns, and global trade friction risk. Second, big tech earnings and guidance are raising new questions about AI CapEx spending. When AI enthusiasm cools, tech multiples compress. When tech compresses, high beta assets get repriced. And crypto is one of the highest beta assets on the board. So when macro gets nervous, crypto absorbs the shock. This isn't mystical. It's positioning. Where could this go from here? Short term, $60,000 is the next major psychological battlefield. If that breaks decisively, liquidation acceleration becomes very real. Medium term, if we see tariff de-escalation or cooler inflation prints or stabilization in AI CapEx narratives, you could see a relief bounce toward the 68 to 70,000 range. But right now, the market is pricing uncertainty, not optimism. All right, after the break, we'll talk about the liquidation wave that made this move even more violent. We'll be right back.
Some mornings start quiet. No rush, no noise. Just good people and the decision to roll forward.
Welcome back. The liquidation machine is running hot again. Over $240 million liquidated in a single hour, mostly longs. And this wasn't an isolated candle. It was part of a broader sell-off that erased roughly 3 to 4% of total market cap in 24 hours. Bitcoin down about 5% at the lows. Total trading volume spiking above $102 billion. That's not calm repositioning. That's forced exits. So let's break this down. Who got hit? Mostly leveraged retail longs on Binance, Bybit, and OKX. High leverage, tight stops, thin liquidity. Analysts at CoinGlass and Bybit were tracking the liquidation numbers in real time, while institutions mostly sat on the sidelines or hedged quietly. When did this hit? The biggest wave landed in the last 24 hours, February 23rd into the 24th, right as Bitcoin broke below 63,000. That level mattered psychologically, and once it snapped, the cascade began. Where was the pressure strongest? Centralized exchanges globally, but Asia sessions contributed heavily. High leverage culture, high volume participation. When volatility spikes during those sessions, liquidations accelerate fast. Why did this happen? Thin liquidity met over-leveraged positioning, met fresh macro-selling pressure. Tariff escalation headlines, tech weakness, AI capex concerns. Then, a key support breaks and the algorithms don't hesitate. Margin calls fire, stops trigger, market sells hit the book, price drops more. It becomes self-reinforcing, mechanical. Now here's the part people miss. Liquidation waves feel catastrophic in the moment, but they also reset leverage. After major flushes, positioning becomes cleaner, less froth, less forced pressure. So what should we watch next? If daily liquidations fall below $100 million, that suggests leverage has cooled. That's when price action can stabilize. But if we see continued heavy waves, Bitcoin could drift toward the 58 to 60,000 zone, not because of narrative, but because the book below is thinner than people think. Right now, sentiment is crushed. ETF outflows are adding pressure, and traders are bracing for more pain if supports fail. But remember, liquidations are symptoms. Over-leverage is the disease. All right, after the break, we talk about the one guy who seems completely unfazed by all of this. We'll be right back.
She redefined what it meant to race without limits. She proved that silence could be louder than words. Fearless, fast, focused. A reminder that champions are built on grit. That same intensity now fuels her signature blend. Roosted and roasted. Bold Italian roast crafted with the spirit of champions. Ashley's Roosted and Roasted, only at wholeshotcoffee.com.
And we're back. Okay, while the market is liquidating longs, while traders are refreshing their charts every 30 seconds, Michael Saylor is buying. Again. Strategy, formerly MicroStrategy, just executed its 100th consecutive Bitcoin purchase. They added 592 Bitcoin, spending roughly $39.8 million at an average price of about $67,286. That brings total holdings to approximately 717,722 Bitcoin. At current prices, roughly $55 billion in value. But here's the uncomfortable part. At today's market levels, they're sitting on nearly $10 billion in unrealized losses. $10 billion. And yet, the buying continues. So let's break this down. Who? Strategy, a U.S. public company led by Executive Chairman Michael Saylor, arguably the loudest corporate Bitcoin advocate in the world. He hasn't softened his stance. He hasn't hedged publicly. He hasn't changed the thesis. When? This latest purchase was announced and executed in the last 24 to 48 hours, February 23rd into the 24th, filed through SEC disclosures, confirmed on Saylor's X account. This isn't rumor. This is corporate treasury action. Where does the money come from? Equity raises, convertible notes, structured capital raises tied directly to Bitcoin accumulation. This is a machine at this point. Why keep buying here? Because Saylor's thesis hasn't changed. Bitcoin is the superior long-term treasury asset. Volatility is noise. Drawdowns are opportunity. He views this dip not as a crisis, but as generational accumulation. Now, here's where it gets interesting. If Bitcoin rebounds above $80,000, those unrealized losses flip into massive gains. And suddenly, the strategy looks brilliant again. But if Bitcoin drops toward 50,000, the paper losses grow. The headlines get louder. The conviction gets tested. But this is what long-duration positioning looks like. It doesn't react to hourly candles. It commits to decade math. Whether you agree with it or not, this kind of consistent buying during extreme fear environments acts as a psychological anchor for the market. In a sea of panic, consistency stands out. All right, after the break, we zoom out and talk about sentiment because it's sitting at levels we haven't seen in years. This segment brought to you by long-term thinking, because 5-minute candles don't build generational wealth. We'll be right back.
You're listening to the SENB Daily Brief, powered by Whole Shot Coffee.
Welcome back. Fear is the dominant emotion across the entire market right now. Not just crypto. Gold, down. Stocks, down. Crypto, obviously down. There is no safe corner of the screen today. The Fear and Greed Index, tracked by alternative.me, is sitting in the single digits, 7, 8, 9, one of the most extreme fear readings ever recorded, and it hasn't meaningfully improved since early February. Social sentiment platforms like Lunar Crush and Sentiment are flashing the same signal. Retail panic is loud. Institutions are quieter, but still cautious. And when both sides lean defensive at the same time, volatility doesn't calm down. Analysts are now calling this Bitcoin's worst month since June 2022. And it's not happening in isolation. Gold down roughly 1%, broader equities under macro pressure, risk assets getting repriced together. So why does this feel so heavy? Because fear is feeding itself. Cascading liquidations, record realized losses, tariff escalation headlines, and fading post-election optimism. That combination creates a feedback loop. Price drops, sentiment collapses, selling accelerates, narratives darken, and the loop tightens. But here's the important historical context. Extreme fear levels like this have often marked major cycle bottoms, not always immediately, but consistently. The first signal of relief, a sustained move back above 20 on the Fear and Greed Index, and ETF inflows flipping back to positive. Until then, the emotional environment remains fragile, and fragile environments produce exaggerated moves. Right now, the market isn't asking, how high can we go? It's asking, where does the bleeding stop? All right, coming up next, we talk about the structural vulnerability analysts are warning about and the possibility of a deeper flush toward 55,000. This segment brought to you by Emotional Discipline, because markets test conviction before they reward it. We'll be right back.
Monday morning starts here, coffee in hand, ready for the grind. Leaving the bike behind, chasing the week ahead. Fueled by the passion to ride and the coffee that gets us there. Whole Shot Coffee. Fuel your life.
Welcome back, everyone. Now, analysts are no longer whispering. They're openly warning of more pain ahead. The phrase being used today is massive flush toward $55,000. Let's break down who's saying this. On-chain analysts, macro desks, firms like Standard Chartered, Bloomberg Intelligence, and yes, even retail influencers echoing the same structural concerns. So what's the argument? Bitcoin is vulnerable if support levels fail. The zone being cited as the next major liquidity pocket is roughly $55,000 to $58,000. Not random numbers. That's where thinner liquidity meets historical structure. And here's the key red flag being highlighted. The Coinbase Premium Index has been negative for over 40 days. That suggests persistent weakness in U.S. spot demand, meaning buyers are not aggressively stepping in on Coinbase relative to global exchanges. For a U.S.-driven asset narrative, that matters. Add continued ETF outflows, add macro headwinds, add tariff escalation risk, and you get structural fragility. So here's the conditional path forward. If Bitcoin breaks below $60,000 decisively, algorithmic selling and forced liquidations could accelerate the move toward 55. That's the flush scenario. But there's another path. If 62 to 63,000 holds firmly, if ETF flows stabilize, if macro delivers even a mildly positive surprise, the flush thesis gets invalidated, and you could see a relief rally back toward the upper 60s. Markets don't move on certainty. They move on pressure. Right now, the pressure is to the downside, but pressure can reverse quickly. This is the kind of moment where structure matters more than emotion. The next few daily closes around 60 to 63,000 will likely define the next several weeks. All right, that's the top 5 for today. And this segment was brought to you by patience, because volatility is temporary, positioning is permanent. When we come back, we'll see what all of you have to say. The Proof of Thought mailbag is next.
You're listening to the SENB Daily Brief, powered by Whole Shot Coffee.
All right, it's time for Proof of Thought mailbag, where you panic in the comments, and I respond with logic. Let's begin. First up is from @DiamondHands1975 and asks, be honest, Sen, is this the start of a multi-year bear market? Diamond Hands, my friend, if you have to ask every time we drop 5%, you may not actually have diamond hands. Here's the honest answer. We do not declare multi-year bear markets at local panic lows. We watch structure. We watch liquidity. We watch flows. If 60,000 breaks with conviction and stays broken, that's structural damage. If it holds and leverage resets, that's volatility inside a broader cycle. Right now, we have stress, not confirmation. Okay, next one comes from at liquidated again and asks, got stopped out at 5 times leverage. Should I revenge trade? No. I'm going to say this slowly. Revenge trading is how exchanges buy boats. If you just got liquidated, your nervous system is not neutral. Step away. Let volatility settle. Capital preservation is a strategy. Panic clicking is not. Third question is from at Macro Mike, and he asks, is this all because of tariffs, or are we just overextended? Good question. It's rarely just one thing. Tariffs add inflation uncertainty. AI capex doubts hit tech. Tech weakness spills into crypto. But leverage amplifies everything. Macro lights the match. Over leverage spreads the fire. Okay, next one is from at Saylor was right and says, should I just copy Saylor and buy every dip? Are you also raising convertible debt and issuing equity to fund treasury strategy? Didn't think so. Saylor is playing decade math with corporate structure. Retail traders are playing hourly volatility with personal capital. You can admire conviction without copying strategy blindly. This next one is from at Fear Index Watcher. Sen, fear and greed at 8. Is this a bottom? Extreme fear readings are historically associated with major bottoms, but they do not tell you the exact candle. Fear can stay extreme longer than comfort allows. The first real signal will be stabilization and flows turning positive. Not just one green day, sustained improvement. Okay, last one for today is from at Long-Term Larry, and he wants to know, I'm down 30%. Should I sell and buy back lower? Larry, this is the question every cycle. If you sell here, you need discipline to buy back when it's even scarier. Most people don't. If your thesis hasn't changed and your position size is survivable, sometimes the hardest trade is doing nothing. All right, that's today's therapy session. Remember, markets are emotional machines. Your edge is not prediction, it's discipline. After the break, we close this out properly. Final thoughts coming up next.
Our beans are washed in ancient waters, filtered through coal seams deep beneath the Utah mountains. Okay, not really. We totally made that up. But it does sound badass, doesn't it? Here's the truth. Premium Guatemalan beans, aged for 30 days in real whiskey barrels, then carefully roasted smooth in the golden light of California, inspired by the legendary Drunkard's Wash Desert Race in Price, Utah. Bold, smooth, with a subtle touch of whiskey and oak. Drunkard's Wash. Whiskey barrel aged, bold and unmistakable. From Whole Shot Coffee Company. Fuel your life.
All right, let's close this properly. Today wasn't mystical. It wasn't manipulation. It wasn't a conspiracy. It was positioning, meeting reality. Leverage got ahead of liquidity. Macro pressure applied stress. Support levels broke. And the market did what markets always do when they're overextended. It corrected. Extreme fear feels dramatic in the moment, but historically, it's where long-term decisions are quietly made. Not by the loudest voices, but by the most patient ones. Here's the truth. If 60,000 breaks hard, we may test 55. If 62 to 63 holds, this becomes another violent reset inside a larger cycle. Either way, panic is not a strategy. Discipline is. Position sizing is. Time horizon clarity is. And remember something important. Fear at 8 does not mean the end. It means people are uncomfortable. And markets are built to transfer assets from the uncomfortable to the disciplined. Zoom out, breathe, let the leverage wash out, and cry rationally. Okay, that's it for today. If you like what we're putting down, then give us a follow and share the show with all you know. I'll see you in the next one. The SENB Daily Brief is a production of SENB Hero Media in collaboration with Whole Shot Coffee, coffee that fuels champions. Written and hosted by yours truly, SENB Hero. Production, editing, and scheduling handled by Maya Valencia. who somehow keeps me on time, caffeinated, and occasionally polite. Original theme music composed and produced by Paul Hahn, the community legend whose beats hit harder than a Fed rate hike. Research support provided by the SENB community. Proof that sarcasm and spreadsheets can coexist. For more shows, merch, and on-chain chaos, visit SENBHeroMedia.com. Thanks for tuning in. Stay caffeinated. And remember, if it's not in the brief, it probably wasn't bullish anyway.
Set my wallet free.